Did not have a great end. I lost $30 million.
Hello, and welcome to Mornings with Joel, commercial real estate podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace.
The Morning for Joel CRE podcast is sponsored by ImpactMask.com. That's M as in Mary, ImpactMask.com. The world's most breathable mask that has 99% efficacy, which is higher than an N95 mask, and it won't fog your glasses. Check out the science behind these incredible masks at ImpactMask.
Good morning, all. We want to welcome you to the Mornings with Joel CRE podcast. We have a very special guest with us today, Daryl Carter, who is an absolute legend in the multifamily space. But he's kind of a gentle giant, so if you don't know him, don't be surprised. But let me tell you, you will, because he's a true player in the commercial space. You know, one of those guys that you say, no, he's for real. So, you know, you'll appreciate what he has to share with us today. So, Daryl, how you doing, man? Good to see you again.
I am great. It is fantastic to be here. It's great to see you. We've all been sort of in our hibernating corners over the last few years, and it looks like we're starting to get back out. And it's delighted to see you, Joel. I've listened to a number of your podcasts, and you do an amazing job. So keep up the great work.
Oh, man. Well, thank you very much. I didn't know you were one of our listeners. So I really.
Oh, yeah.
Yeah. Fantastic. So, Daryl, obviously, we've known each other for a while, but for the sake of our audience, you know, you're not an upstart to the multifamily space. And what was interesting is, well, just tell us a little bit of your background, you know, where you're from, how you get to Southern California, and why real estate, you know, what really kind of led you down this path?
Well, I like to think, you know, I tell people, they say, wow, you're successful. I say, yeah, I'm an overnight sensation. I've been doing it for 41 years. By way of background, I grew up in Detroit. I went to school at the University of Michigan. I played basketball there. And then I later went to graduate school at MIT. And then my first job I took in Chicago, working at Continental Illinois Bank, which eventually became B of A, you know, and worked 10 years in kind of corporate world. And then in 1992, started a company with a longtime friend and still a longtime friend, Quentin Primo, and we started Capri Capital. Quentin and I went to high school in Detroit.
Now that I didn't know.
Yes, we were Cass Tech High School. So we started Capri and really to create an investment firm that targeted underserved markets. And we had an equity business and a debt business. And, you know, we built those, you know, that platform up to be almost $8 billion of assets under management from 1991 to 2005. And then we sold our debt business. We were a Fannie Mae, Freddie Mac, FHA lender. We sold that to an affiliate of the related companies, and I continued to run that. And then eventually at that point, you know, Quentin and I, who remained great friends, we kind of wanted some different things. So we ended up separating at that point, and Quentin took the equity business. And then I later, 2-3 years later, started the company that I have now, Avaneth Capital Management, with some of the ex-Capri team on the West Coast. So, you know, and I would say that my premise for most of my investment business is, you know, when I grew up in Detroit and I saw the transition from the 60s to the 70s, it was a function of disinvestment where people stopped investing. And I had a premise that if you start investing in some of these underserved markets, you can have a positive turnaround. And so that's really been the thesis, you know, very simply with both businesses that I built, that if you make the right investments in underserved communities, you can move the needle in a significant way. And so I started Avaneth in 2008, and we've built about a $4 billion apartment portfolio, primarily in the affordable housing sector. We operate about 16,000 units that we own in various partnerships with institutional investors. And then We manage another 4,000 units as either we have a partnership with another company in North Carolina, which is a black-owned firm, Laurel Street, of Dion Nelson,
Okay.
my great partner. And so, we operate almost 20,000 apartment units, which comprise probably 50,000 of people, and most in Black and brown communities.
All right.
That's my story.
Yeah, yeah. You're sticking to it, right? So, no, that sounds good. I tell you what was interesting to me is, at one point, Quentin Primo's star was really glowing, if you will. And I was asking him, I was like, where you get that name from? Capri. And come to find out, it was a mixture of
Carter and Primo.
Primo. I was like, how about that?
I wish I could be more original. My current company name, Avaneth, it comes from my daughter Ava and my son Nathan. So I that's the best I got.
I got you. Well, that was always in the back of my mind too. I was like, where you get that name from? Because it's a little hard to pronounce sometimes, but definitely stands out as unique. So that's interesting.
Well, my kids are they're very close in age. They're about 18 months apart, and they have an amazing rivalry all the time. And she likes to point out that her full name is in the company. He likes to point out that he has more letters. So,
all right, well, we'll let them have like Oh boy. Well, let me ask you this. Just kind of going back a little bit. You mentioned about when you left Capri and you sold off the debt business. But '07, I mean, you and I both remember that period of time. '07 was when the sky started falling, from that standpoint. And obviously '09, things really got ugly in '08. Why in the world did you think that was the right time to start a business? Was it just because of the sale of the other business? You were cash, liquid, or was it just some other reason? Because it sounds crazy with the sky falling that you would go out and start another business.
Well, couple of things. One is that I felt that the way affordable housing in the U.S. was operated, that there was a better mousetrap. So I felt that regardless of any cycle. But, I did get involved in a very large potential acquisition, and not potential, it was an acquisition we did when I launched Avaneth in 2008. We acquired a company that had a GP interest that in about over 20,000 apartments. And I put $30 million of equity in it. We borrowed a bridge loan of $300 million that I personally guaranteed some of it. And it was a 1-year bridge loan. So part of life, and that closed May 1st, 2008. And it was due April 30th. That's why I know there are 30 days in April, because I could have used one more day. But anyway, it did not have a great end. I lost $30 million of equity investing in that transaction. And so my company, that was our first deal. We were off to a pretty bad start. I mean, but, in many things, I think that situation helped shape the knowledge base of what it was a very expensive tuition. I learned a lot about, in the affordable business, you can't over leverage, which most people do. And that the bottom line operations were tantamount and generating cash flow. And most people and most investors who have been primarily tax credit oriented have never demanded that cash flow. People focus on fees and tax benefits. And I felt that you could build a business where you could get operating cash flow out of affordable assets, which we have proven. So, at the end of the day, and I didn't realize it was going to be, if I'd known it was going to be that much of a down market, I wouldn't have started then. I would have waited 2 years later. So it's not as if, but it's interesting. We started Capri in 1991, which was not a particularly good year. It was all the RTC liquidity. Yeah. So it was all that. So, down markets, which I think we're about to hit one, I think it's the best time to launch new endeavors. I mean, when you think about it, if you're in a market where there is great people are having success, why, the incumbents in a particular sector are going to dominate. You're not going to have someone new kind of emerge. And I remember in the early 90s when Quentin and I were raising money at Capri, part of what we'd say, whatever investment dollars you have, we're going to focus exclusively on our portfolio with you because we have no portfolio issues.
Mm-hmm.
We didn't need to say, we really don't have any other portfolio. But at the time, we didn't have any portfolio issues that most investment firms had at that time. So sometimes being new and having no negative is better than being big and established and having, negative things. Or at least that was the spin we put on it, which is actually true.
Yeah, yeah. Yeah, no, that's a good point. That, being able to realize that you don't have other clients and, to save per se. And so you're able to focus on those and kind of build from there. But you bring up a very interesting point because it takes a degree of fortitude to be able to say, okay, things are getting off to a rocky start. The economy's going crazy. I mentioned 9/11. That was an error because actually in 91, it was the RTC issue. It wasn't 9/11. That was about 10 years later. But
Right.
But still, being able to fight through that adversity and those challenges in the market and continue on takes a bit of a gut check. Why do you think you've been able to do that and be successful in pushing through? I mean, is there some secret sauce or just, you don't want to give up?
Well, I think it's a lot of things. I mean, you grew up in humble beginnings. My dad was an auto worker and I just always we did not have very much, but I didn't know that. But I think that in good markets, bad markets, there's ability to, things work. I mean, one of the things that with my acquisition team, probably the average tenure is probably 15 years maybe. So most of my acquisition team members have only seen an interest rate environment in the low twos.
Mhm.
And sometimes I know because I look at them when I tell them that my first mortgage loan that I got in 1983 was at 13.5%. And they look at me and I know they're thinking, wow, he was really a bad credit. That was
Yeah.
subprime. But I mean, but
It
that's
wasn't.
where interest rates were.
Yeah.
But one day I was just hearing, well, my God, rates have gone up. And I went and did a chart from 1981, which was my first year, to look at the average treasury rate from 1981 to today. And the fascinating thing is that only 20% of the time that I've been in business has rates been lower than where they are now. We're still at a relative historic low, but it doesn't seem like that because for rates to go from in the twos to five seems like,
Yeah.
but I mean, the first 15 years of my career, rates were double digits,
Mm-hmm.
and people talk about, well, they don't want to have negative leverage. And because we've had, where you borrow and you get positive leverage with you're buying at a 4 cap and your debt rates are 3, it works.
Yeah.
Well, now, maybe cap rates are going to be 4.5 to 5 in apartments and you're borrowing over 5.
Mm-hmm.
But we had periods of time when we were getting 8, 9% returns and we're borrowing at 12. And we just figured out have to get the cash flow up to that level. So operations become a lot more crucial. And again, it's a matter of perspective. When you look at historic times, we are still have relatively low interest rates.
Yeah, yeah, it is absolutely relative in all sense of the imagination, as it relates to that. But like you said, it's all relative. People look at it and they're, think the sky is falling, but it's really not. It's just going back to more so what's normal. So definitely want to mention that. Now, I did want to pivot into something else because I thought this was interesting, and I'm gonna pick at you a little bit. But you're there in Newport Beach, fabulous, one of the wealthiest parts of the country, and your focus is not on people that basically live in your area. You focused on the inner city and the other areas. And what's so interesting about it to me is that there was a mantra of you could do well doing good. Me and Kirk Sykes have talked about it. You talked about it. Quinn's talked about it. We've all talked about it, right? And the question is, who's really going to do it? Who's going to step up and make that happen and prove the model true? And one reason I wanted to have you on is because you've absolutely proven that model. So how tough was it in the early days when people were saying, I don't want to invest in Southern California and Watts in those areas. I don't want to invest in Harlem. I don't want to invest in Detroit. Those areas are horrible. And you're saying, no, that's where we do want to put our money. How did that all work out? Because that seemed like a tough mountain to climb.
Well, you touched on something that I rarely talked about. I just have to say one thing relative to. I spend a lot of time in Detroit these days. We're developing a project. I'll get into that later, but
Okay.
I spend a lot of times, and every time I go to Detroit, I always go to my own neighborhood and I see my aunt. And I always find when I come back home, it is like being in two different countries. Just as an aside. But getting back to, we had a period of time, and and there's been a lot of focus on investment equity and things like that. And back in the early 90s, and after the whole Rodney King thing in LA, a lot of institutional investors, and Quentin and I, we were in the early days of Capri. But then there was my good friend Victor McFarlane, who had started his company 2 or 3 years earlier. There was my good friend Richmond McCoy, who started a few years after us. And one of the things that we all came together to do is to convince some of the big pension funds, and one of which was CalPERS, and all three of us did business with CalPERS, was to convince them not about that you should invest in these communities because it's the right thing to do. But at the time, there was this huge thing about emerging markets and investing in the Brazil and other places like that, and seeking very attractive returns.
Mhm.
And what we came together and really spent time with the trustees and elected officials to explain that people in South Central LA, they shop. They need retail centers. People there have disposable income. They need apartments and houses and things like that. But convincing institutional investors that there is a viable economic engine in many communities that are underserved by capital. And so less, really focused on the business opportunity, and many of the things that we had to counter. And I'm not a retail expert by any means, but you would look and say a suburban shopping center, which has 5 spaces per 1,000 square feet. You go to a place in a grocery store in an older urban community that may be African American, and all of a sudden it has 2.5 parking spaces per 1,000 square feet. Institutional investors, and I don't think it's redlining, but they're saying that doesn't meet our investment criteria because we like to see 5 to 1. And what we had to convince them is, look, it's very high density area. A lot of people walk. A lot of people take public transportation, and they manage it. It's still, the sales per square foot is very, very high.
Sure.
But many times institutional standards, which evolve from the newest properties, dictate the standard. And then, and not to say there isn't red line for racial reasons and the other, but I was convinced that more the issue were the institutional standards that evolved, and then putting our real estate hats on and really walking through why it could work at that level. And again, we stayed away from, it's a Black neighborhood, you should just do it. But what we said, no, there's a hell of a business case. You can make money, and there's lots, and there's a need for nice grocery stores and things like that, and housing that in communities of color. And still to this day, our investment thesis is about the investment need and the ability to deploy capital safely and generate attractive market returns.
Yeah, yeah. Because at the end of the day, it should all be about the numbers. One thing that came up a lot was, the majority of the people that work for the city where that money's coming from, like say CalPERS that are state workers and whatnot, all the people living in these inner cities. And yet
Yes.
still their money is being invested outside in suburbia. That really doesn't make a lot of sense either, from that
Yeah.
standpoint. Yeah. So I don't know if that came up a lot in your discussions, but it's something that I know as I've heard floated around from time to time.
Well, the investment world, it's still challenging. People have a lot of myths. You say something like Section 8 housing. And people say, oh my God, don't want any of that. I mean, 40% of our doors, our households are Section 8 voucher holders. And then what I say, and people have perceptions, but our payment default in our Section 8 portfolio is less than 10 basis points. And I mean, I am a big data person, and we use data to support our investment thesis. And you can't argue with that. I mean, the industry standard in apartments is typically, and pre-COVID, I think it's higher today, is that the rental default rate is probably between 50 and 150 basis points. Ours is about 30 basis points. So, I mean, numbers don't lie, but there's still a lot of stigmas. I remember having, and I've told this story many times, but I had an investor who was going to look at one of our properties in Loudoun County, Virginia, which is, outside of Dulles Airport, probably maybe one or the first or second most affluent market that we're in. And, and it's an affordable property, but just to give a sense, the area median income where rents are pegged to are about $120,000 a year. So 60% of that, people were making $70,000. And these are people who are working out in the tech corridor in Dulles. And so the investment officer of a very large public pension fund was flying in and was going to go look at our property. Called me the night before and said, is there any possibility that I'm going to get shot if I show up at your property tomorrow? And my response was, well, I don't know your personal situation. I don't know who you owe money to, whether you have an angry mistress or an angry ex-wife. I said, notwithstanding your personal situation, I said, when you go to our property tomorrow at 10 o'clock, it's going to be empty because everybody works. But the perception is that it's affordable housing and the demographic of that was, I mean, the funny thing is all of our properties, whether it's Hispanic, white, Black, Asian, whatever the ethnic group, our properties are comprised of people who work very, very hard to pursue the American dream, and they're focused on advancing their families and the like. And so that's what affordable housing looks like. But there are perceptions maybe stemming from, housing projects in urban areas and the perceptions, which are just don't match reality. And so a lot of what we do is educating investors as to what it is and what it means. And the fact that you come to our properties during the day, it's empty because people work.
Yeah. That's interesting. I was just thinking of a similar situation. We're modeling a property right now that we're considering acquiring. It is an affordable play. What's interesting about it is when I was first asking about it, the realtor said, well, did you ever see the TV show The Wire? And I was like, dude, come on, man. It ain't that bad. Because, but that's the perception.
It is the perception.
Yeah. And I drove the property as nothing like that. But again, to your point, when they're coming from affluent suburbia, that's the mindset.
You know what has been transformative to us, Joel, is we started about 7 or 8 years ago, and it's been the fuel of our growth, is raising capital outside the U.S. And specifically, we've been focused on 4 countries: the Netherlands, Switzerland, Germany, and the UK. And one of the reasons why that has been fascinating, and number one, we've had traction, and now about 45% of our capital comes from those, from institutions in those markets.
Mhm.
But the other thing is I've learned the housing models of places like Germany. And when you describe Section 8 housing to a German investor, they say, oh, we have that here. And it's a good thing. I mean, somehow one of the problems we have with housing in the US is that there are a lot of other factors, one of which is race, that just gets involved in the mix there, and it really shouldn't be.
Right.
I mean, the fact is that most housing in rental housing in places like Germany are mixed income, and you don't know who's getting a subsidy, but some people it's varying levels of subsidy. And but matters of race and all this other stuff just doesn't go into the housing business as it does in the US.
Yeah.
That's what we need to change.
Yeah. Well, that's a powerful point because they really didn't have those countries didn't grow the way the United States grew, on the back of a slave culture and whatnot. It was totally different. So that's a valid point. But let me ask this. You mentioned about 40% of your revenue pretty much comes from Section 8. Do you model that when you go out to acquire a property, or is that just kind of an added bonus to allow you to juice your returns once you get into the property?
Part of it is that 85% of what we own is some rent regulated affordable property. It was either built with tax credits. Some we have that have local affordability, like New York rent stabilized properties, or state affordable programs, or project based Section 8, where it's actually all Section 8. And so there's an infrastructure in the affordable housing world that starts with HUD and then it goes to state agencies. We're in 15 states and they're state housing finance agencies. And two that we're very involved with are Florida and California. They're, two markets we're in. And we develop very good relationships with those agencies. And then there's a series of public housing authorities, Sacramento, Chicago, the housing authority of the city of LA. I mean, so we develop a relationship with them. And so they administer the affordable housing. They generally administer the Section 8 program. So we're very welcoming to housing vouchers. And so they are delighted, with the relationship that we built and that we accept Section 8 vouchers. And we found them to be very, very good partners. We also try to be a good steward of taking care of those residents and creating, quality environments for them to live in. So those relationships becomes really important. And we've learned that the city housing authorities that administer the Section 8 program, we have great relationships with them. We always are open to trying new pilots with them. I mean, probably the best thing that happened with COVID is that many housing authorities who used to insist on physical inspections for their properties will now do electronic, where someone walks the property in FaceTimes and things like that. But we've been able to do far more online rentals post COVID than we did before, and mainly because we work with the housing authorities to monitor to improve process and procedures. So, Section 8, we've really built our company around the affordable world. Section 8 is a big part of it. I have 15 people that are in our compliance area that knows every different, nuance of the Section 8 program and different types of vouchers and the inspections and all the other audits. So, we've really built around that sector. And a lot of landlords, they view it as they don't want it. But I will tell you this, the worst month of collections we had during COVID was 98%. And part of that was the durability of the Section 8 portfolio, because there were enhancements made immediately to shore any economic losses of Section 8 recipients. So in other words, when that was in the first bill that passed. So if we had a Section 8 resident that had suffered an economic loss, it was easy for us to redo their status, and then Section 8 HUD would make a bigger payment. So some owners got into it after they realized the durability of it, but it's a key part of our business. And we think that the residents who are Section 8 recipients, they're all hardworking people pursuing the American dream. And we continue to do things to support and elevate that resident base.
Gotcha. So would you actually put that in your pro forma, that you're expecting like a certain percentage of the development?
Well, we primarily acquire and rehab. So very often we will have a tenant base in place that will have a number of Section 8 residents. And, again, we're always open to the local housing authorities, to have voucher residents. And I could think of Chicago, where we have a great relationship with the housing authority there. We have a building that actually was a redevelopment out of the Cabrini Green neighborhood, where we have market rate residents and we have public housing residents that the CHA provides us. And people say, well, how does that work? And I said, it works very well. You know why? You give everybody the same apartment. Everybody has the same. This is
The poor section.
right. This is everybody gets the same apartment, and you treat everybody with the same level of respect, and you provide high quality customer service to everyone. So that's why it works. And whenever you start doing, what's that in New York, the poor doors and things, and that's a disaster. But
Yeah.
that, so we're adept at doing mixed income housing and with people at different lower, income levels.
Right, right. Now, one thing I did want to touch on, you mentioned that you were going to talk about a development in Detroit, and usually individuals that are in the space that you're in don't develop. I know the reasons why for the most part, but I wanted to ask you about that because you said your whole model pretty much has been acquiring and rehabbing. Why would you look at a development deal now? I'm sure it has to do with basis, but I'll let you tell us about that.
Well, a couple of things. It's interesting. The city of Detroit in 1960 had about 1,000,007 people. It was the fifth largest city in the country, and today it has about 700,000 people. So 1,000,000 people left, and I guess I was one of them. So there's a lot of vacant land in the city, and I do think that when after the bankruptcy, and I've never not because of relatives, family, University of Michigan. I always had my eye on Detroit, and I'd always go back and is it time? Should I invest in it? And I think in the recent years, I've been impressed with the way the city has turned around and the opportunities. One of which, Quicken has a big presence. There have been other industries, but the big industry in Detroit is automobiles, of course. But one of the things that is happening there, a lot of the Googles and Apples who, you heard 4 or 5 years ago about driverless cars, and they're coming. Well, what most of these companies, including Tesla, hasn't, they now realize that the expertise in putting a car on the road is in Detroit. So all of them have partnerships. I think Ford has one with Google, but there are a lot of people moving into that community that are knowledge-based workers. And so we felt very bullish about maybe it's the time to invest. And, we have a relationship with the mayor and who was very encouraging. And there's because the footprint of the city was so big, there's a lot of city-owned land. So we are developing with a very good friend who you may know, Ron McDonald, RFC Development. Well, Ron's my partner. Ron is from Detroit as well. And we always like to say we speak Detroit. And so Ron is my partner, and we are developing 200 apartments. We started down this path in 2018. We expected that we would have been fully leased by now, but we haven't broken ground, and that's just because of COVID and some other factors. But we're still very bullish on the property. That's the challenge with development. We started that in 2018, and we've acquired over $2 billion of properties since then.
Oh, wow.
I still haven't broke. No. Nationally, we've acquired over actually $2.5 billion worth of properties since we started on that project, and we still haven't broken ground yet, but we expect to do that this year. But, we felt that, part of our business, in the affordable housing business is obviously preserving existing affordable housing, but we have to figure out innovative ways of adding supply. And so with our property in Detroit, in a way, it's a public-private venture where we're building on city land where it makes the economics more favorable. And so we're increasingly looking at those opportunities to add to the supply generally in structures that help the economics. I mean, it's very difficult. I mean, particularly in California and New York, I'm on the board of one of the very large nonprofits, which does an amazing job, and that's Bridge Housing, which is based in San Francisco. But a new development, even an affordable development, is over 700,000 a unit. And it's just hard to do that without a lot of public subsidy.
Sure, sure. Yeah, yeah. No, and that's the reason why. I mean, it's often said you can't develop a C grade property or even a B grade. Generally when you're building something, it's just the cost, right?
The 2x4 doesn't know whether it's going into luxury or
There you
affordable.
go. Right. Exactly. Exactly. So you're right. The only way to drive that cost down is subsidies or cheap land basis or something, in order to get that down. So that makes perfectly good sense. I do want to mention this. We're about 10 minutes past the time that I generally open up the room for questions from the audience. So if you guys want to start putting those in the chat, we'll start entertaining those questions at this time. But while we're waiting for those to come in, I did want to talk to you also about the opportunity zones. I'm assuming a lot of your projects would be in opportunity zones simply because of the nature of where they are and where opportunity zones are. So has that been a great benefit to you, or how's that all playing out right now?
Well, our Detroit property is in an opportunity zone, so that has been helpful. And you're right. I mean, we were in opportunity zones before they were opportunity.
Before opportunity zones, yeah.
And I really believe it's a good program, and I think and I actually have developed a friendship with Senator Tim Scott, who was sort of the architect of that, and I think that there are a few enhancements that might be made that would make it more viable, particularly in underserved communities. For instance, the 100% basis, if that could be 50% basis in adaptive rehab, I think that would be better. But I think it's been a good program, and it's certainly attracted additional institutional capital. So yeah, I'm positive on it, and I think though that the jury is still out to look back. I mean, it will require probably in the next 5 to 7 years looking back to find out if it was successful, but I believe it will be.
Yeah. Yeah, very good point. I think it's interesting. One good thing is that you're able to drive down those yields that a lot of individuals are looking at because, and when I say individuals, I mean investors. Because generally, if you're holding that deal for over 10 years, you're not going to be at a 20 IRR or 30% IRR in a lot of cases. So, it opens up the door for more investment for ones that are willing to take a lower return. But we'll see how it plays out. There's still some time to go on that, and then we'll see where it works out. I did want to ask you also about you mentioned about not over leveraging properties and especially being true in affordable housing. Can you elaborate a little bit on that for us as to why over leverage is, and obviously there's a lot of economic factors there, but let me let you tell the story as to why you wouldn't want to over leverage a affordable project.
Well, leverage is just one of those factors. I mean, what I have learned in raising institutional capital, you don't want to be where there's a check the box situation. For instance, like being a registered investment advisor. Some investors want to see that in funds they invest, that the sponsor is a registered investment advisor. It's a pain. It's not mandatory. But we became registered and as an SEC advisor and all the others because we didn't want to be eliminated by simply that. And I think that in the institutional world, particularly as we started going and venturing outside the U.S., a lot of investors just like low leverage, and we've been able to generate the returns even with low leverage, and low leverage becomes also, which we haven't talked about, but building an enterprise that has sustainability. Our debt service coverage is probably 3 to 1. So if there's a downturn and our cash flows diminish, we're still going to be able to pay debt. But, building companies to be sustainable to me is important. And it's one of the things that as companies of color, that the sustainability is important, building the back room, building the risk management, all those things, those are the things that I think we need to do to be able to really build larger companies, is to focus on those things that are not as glamorous as doing the deals or making the acquisitions, but it's reporting, the technology, and we've invested a lot in our technology platform. And that's those things, along with the investment thesis that and low leverage. There are more investors that like low leverage than than higher leverage.
Yeah. Well, what would you consider low leverage? Below 60, below 50?
Well, we've launched an open-ended fund. We're limited to 50 on that.
Okay.
And so I think low leverage being under 50 or below.
Okay. All right. Which means
I used to think of it as 60 and below until I started talking to European investors, and they prefer 30 to 40. So 50
Wow.
is a stretch for them.
Wow. Wow. Okay. All right. That's interesting. But you bring up the point of building an enterprise, and I certainly wanted to go into that as, we're down to about 15 minutes here. That kind of goes toward, what do you see as the future advantage? I don't think you're necessarily looking to start another company at this point in your career, but what would you like to see as the future of your company as it relates to, where you're trying to drive this ship?
Well, we believe that, the fascinating thing about the affordable sector is that the top 50 companies in a universe of about 12 million apartment units, the top 50 owners own about 8% of the space. So it's highly fragmented.
Okay.
So we believe, we're at, call it 16, 17,000 apartments that we own and operate today, that we could double that in the next 5 to 7 years to be 30 to 40,000, somewhere in there. So, we have a very ambitious growth approach, and we think, and why grow? Part of growth is you attract better people. You start realizing operating economies of scale, and things like that make you more profitable. And certainly, I look at growth, and one of the challenges, if we started, say, doing retail centers, I'm starting over, building my fixed costs in that. So, once we've established and we've built this platform, to add more to that is really important. And there's a lot of focus on, I spend a lot of my focus on our operating platform, and particularly people, organization. Do we have the right people in the right places? Do we organize efficiently? How do we make decisions? What things can we use technology to make us more efficient? Do we have too many, what is our cycle time for things? And I think about that, because that is the essence of building business, getting more efficient in that side of it.
Yeah. Yeah. Absolutely. Absolutely. So, it's interesting. One of my buddies actually owns a very, very successful mortgage company out in Sacramento. And I remember talking with him, and we were doing lunch out there. And, he said, really running a business is boring. It's not the doing of the deals per se.
Yeah, it is.
Yeah. Yeah. It's the nuts and bolts that really hold the company together. And that stuff is just system after system after system that has to be tight and more efficient over time. That really helps you build an enterprise, if you will.
Yes.
So it looks like you mastered that in two different ways, with Capri and with Bennett.
Well, I'm not sure you ever master it, but you have to stay focused on it. And the great thing is, some of the innovations that are out there. I spend a lot of time looking at the prop tech companies that are coming and doing enhancements. There are just some great products out there that some of what we try, and probably the best one, and I'm going to give a little shout out to, there's a company called Isuzu that does data analytics, that does reporting to credit agencies, but they have an affiliation now with Fannie. And what they do is they report rental credit history to the agencies that are, the Equifax and the like.
Mm-hmm.
And so the amazing thing is, we've adopted their data analytics at probably 2,000 of our properties. And, and I didn't know it, but, we had probably 200 residents that had no credit history, they were credit ghosts. And now they have a credit score. And more importantly, our average credit score increase of our residents has been about 60 points, which is meaningful.
Mm.
So there are a lot of things we look at in making investments in making our residents be stronger financially. That's a benefit to us. That's part of the enterprise, is looking at ways you can use technology and things that are out there to make you more efficient.
Right, right. And I actually love that you mentioned that, because really, I'm sure the business model is not to have people hostage in an apartment the rest of their life.
No,
You know,
no,
yeah. So if you're able to help them by establishing themselves with credit and move on to home ownership at some point, that's a big advantage,
absolutely.
but they're not locked in poverty for the rest of their life. So yeah, I appreciate you doing that and mentioning that. That's huge. Let me ask you one other thing as we discuss this. You talk about using technology, and it's very important. I'm a big tech guy as well. But you have to bridge that gap between the actual technology and using it in the field. And how do you actually do that and bridge that gap between your asset management and the technology? Because obviously, to have that many units, you have some methodology of asset management that's working well. What's the secret sauce?
Well, we continue to try to improve that. And one of the things is that, you always have to be leery of things that you just say, hey, let's try this, or let's do this way, and getting people to buy in. And so one of the things that, I spend a lot of time visiting our communities, and particularly I will, like, we've adopted some new systems for maintenance, for our maintenance tech. So, I'll go and I'll take a few of them to lunch and, like, hey, how is this working? And I get the real story and they tell me.
Right.
And, like, okay, and so sometimes the senior folks, they'll say, oh, this is doing well. I said, no. I said, what I learned is they use it, but then they do the old system to make sure that it works.
That it works.
So now you're doing it twice. And so, it's a lot of training. I mean, one of the things change very rapidly. And so, we have a VP of training that does across our portfolio training of different, operational procedures. We have something that we called a Vanith University, where everybody can plug in. And if you want to learn our big, we use this system called Happy Co, which does property inspections, and it helps on maintenance requests. We have training modules within that. But, getting the adoption of technology, it's just one of those things that you have to do a lot of training, and you have to make people buy into the fact that it's going to maybe short-term issues, but it's going to make their job better in the long run. And you stay at it and recognize that sometimes it doesn't work as well either. So, you have to be empathetic and recognize. I mean, there's certain things that we do understand, that, a rental office in a typical community is very busy, and our managers, our maintenance techs, they have very full jobs, and trying to figure out ways we can ease the burden is always something that we're focused on.
Yeah, yeah. I'm thinking of our own situation. We upgraded our phone system this year, or late last year. And man, I can see why I didn't do that for so many years, because it's just like, oh my God, there's so many things you got to adapt to and get the team up to speed with and everything else. So it's certainly a challenge. Want to wrap up with one very serious point that is really the focus of this show. And that's always advice and recommendations to the next generation. We're trying to encourage, obviously, that next generation of young folks to grab on to commercial real estate and grow careers in that space. And we didn't mention this, but you've done an exceptional job. For y'all who don't know, Daryl is part of the Multifamily Hall of Fame. So if anybody knows what they're doing, Daryl knows what he's doing. So we certainly want to give you kudos for that. So what advice would you have? And I want to address that, and also access to capital. That always seems like that is the biggest issue for anybody trying to get going in this space. What would you say as it relates to access to capital and just overall advice for those that are listening that might want to be the next generation of Daryl Carters coming along?
Well, I hope they will far exceed that. But I would say this, I mean, and it's really access to capital, and to me, the most important part of this business and growing in this business are relationships.
Mm-hmm.
And their relationships, I started in banking, and it was just by chance. There was a peer group that I had and one went on to be the CEO of Equity Residential. One went to be the CEO of Vercadia. And so these are people I started in the training program with when I was in my early 20s. And relationships are really, really matter. And they come in all shapes and sizes. And those relationships create opportunities. And certainly amongst, other developers, investors of color. I mean, Victor McFarland, who's one of my best friends. Victor, we're involved in the redevelopment of one of the largest, was the largest African American cooperative that was built in the 70s in San Francisco, that comprises 4 blocks just west of City Hall. And so our friendship, we're always comparing notes. Hey, do you hear about this? We help each other, but relationships are so important. And it's amazing how, people they disappear and then they show up somewhere, and it may be somewhere of prominence. But I would say my life has been, and career has been, blessed by the relationships that I have. And certainly you're one of those relationships that I've been blessed by. And I think that to me is the most important part and my best advice to anyone.
Wow. Well, thank you, Dal. That was very kind words. I appreciate that. You're so true. We're working on a development deal here in Atlanta, and the guy is, I'll say it, he's Egyptian, and so he has a certain mindset and a certain way of doing things. And it's amazing because he's beating us up about this and beating us up about that. But then I said, look, you know what? I know the presidents or top executives of multiple banks here in Atlanta. Let me make some phone calls to my buddies and see if I can get something done that the average person can't get done. And that changed the whole conversation. But I only know these people because of what you were just saying. When they were quote unquote nobodies, we were still cool, and that was still cool, right?
Yes.
So that's what happens over time, you know?
Yeah.
Yeah.
I think, that's one thing. The other thing is just, many of the innovations in this company are from some of my younger colleagues who have the ideas. I mean, we created a resident app, and I didn't think that people in affordable housing would adopt to technology. I didn't have that instinct, but one of my younger team members had that, and it's taken off. So
Wow.
also, don't surround yourself with people who are different and think differently than you, because it's helpful.
Yeah. Well, that goes back to the whole diversity initiative that we have
Yes.
floating around the country. So that's a big thing. And lastly, have you really seen a lot of that capital get dispersed? Because you brought that up. I wasn't even going to talk about this today, but you know what happened with Rodney King, and then there was so many programs and other things that were initiated. Is that capital actually flowing from what you've been seeing, or?
Well, it did in the 90s. It did in the 90s far more than what I've seen now. There've been a lot of promises made, and I think that many of the institutions, made the promises without figuring out how to execute it. And the other thing that's has been a little bit troubling to me is that you have a number of large companies, one in particular, that said we want to invest in companies of color, and then they partner with one of their customers that is not a minority firm, that has very little diversity, to do the execution.
Yeah.
So I think that certainly the talk has been good, but then the intentionality of actually how it's done and putting meaningful dollars out there is something that we have not yet seen. I mean, certainly none of that has flown to us, but what I'm more concerned about are that next generation of people that I think there are some talented young African American developers that are on the way up, and I think there is a capital need there, and some of which we partner with other organizations, and we've done that ourselves because it makes great business sense.
Yeah, yeah. Well, very good point. I appreciate that, Daryl. Well, I tell you what, we're up against the clock. I always try to keep to my commitments on time. Any final comments you have for us and our audience today? This was a very, very mentally stimulating conversation, and I thoroughly enjoyed it. But anything you'd like to add as well?
Well, I just like to thank you. And I think that some of these conversations you're having are the right conversations and we have to keep having them. And I commend you on the success of your career and these podcasts, but I've found them to be very interesting. So keep on doing it, my brother.
Okay. All right, man. I certainly appreciate it and look forward to seeing you out in California in a few weeks. It should be exciting as well. So, for all of you today, we want to thank you very much for being here with myself and Daryl Carter. Exceptional conversation, and you're always welcome at the Mornings with Joel CRE podcast. Thank you very much, and goodbye for now. Thank you, Daryl. We really appreciate
Thanks.
it.
All right. Have a great day.